This is Optimal Finance Daily, episode 1990, A Flexible Plan for Health Insurance in Early Retirement, Part 1, by Chris Mamula of caniretireyet.com. And I'm your host and personal finance enthusiast, Diana Merriam. I have a bit of a longer post today. I'll read the first half today and then finish the rest for you tomorrow. So let's dive into the first half and start optimizing your life. A Flexible Plan for Health Insurance in Early Retirement, Part 1, by Chris Mamula of caniretireyet.com. Healthcare costs present a major planning challenge for a pending retiree. The earlier one would like to retire, the more daunting the challenge of bridging the gap to Medicare eligibility. America has the most expensive healthcare system in the world. Costs continue to increase far faster than the overall inflation rate. Retirees buying individual health insurance policies tend to have even higher rates than those purchasing through groups. Economic and political circumstances around the Affordable Care Act, or ACA, only magnify these challenges. Some insurance companies have stopped participating in the insurance exchanges. Ongoing political uncertainty surrounding the law has caused remaining insurers to seek additional premium increases for next year. While the ACA has many problems, without it, there would be no guarantee that individuals with pre-existing conditions could buy insurance at any price. Despite the challenges and uncertainties surrounding healthcare, I'm beginning my transition to early retirement at the end of this year. Planning for early retirement under these circumstances requires some risk, creativity, and flexibility. The challenge of projecting healthcare costs. Retirement planning requires projecting future spending and then accumulating the assets to sustain that spending over one's retirement. Typically, one can get a reasonably accurate estimate of their future spending by tracking and analyzing their current spending. However, healthcare is uniquely challenging. Consider this example given in an analysis by the Kaiser Family Foundation if ACA subsidies go away. They note, quote, "A low-income 60-year-old could get a silver plan for $83 a month with ACA subsidies, but would have to pay $775 per month if he bought that plan without a subsidy. Plus, he would have a higher deductible because he would no longer benefit from cost-sharing subsidies that are only available on the exchange." End quote. Using the rule of 300 and plugging in the ranges from the example previously mentioned means that projected savings needs for healthcare insurance premiums would range from $24,900, or $83 times 300, to $232,500, or $775 times 300. Each of our individual numbers will vary based on factors such as age and area of residence. However, the case of this individual is representative of, and possibly even underestimates, the challenges faced by those planning to retire early. In our case, we need to plan for both my wife and myself for the next 25 years until Medicare eligibility. We also need to account for our young daughter for the next 15 to 20 years. Therefore, our potential high-end expenses are significantly larger. Remember, these numbers only consider health insurance premiums, not out-of-pocket costs if someone was sick or injured and actually needed to use their insurance. Predicting our future health status and expenses is equally challenging. An additional challenge is that most retirement projections assume that living expenses increase at the rate of inflation. Healthcare costs tend to inflate at a rate significantly greater than general inflation. Healthcare costs also increase with age as people tend to need more health services. With such instability and unpredictability in this market, unknown personal health risks, and likelihood that healthcare costs will inflate faster than general inflation, we simply don't know how to plug in a number to project future healthcare costs with any reasonable confidence. If we plan for the low-end costs and end up paying the high-end costs, it would quickly devastate our portfolio and/or lifestyle. If we plan conservatively for the high-end costs but never have to pay them, it would obviously be better financially. However, we could waste years working unnecessarily to build such a large additional cushion in our portfolio. our general plan for health insurance in retirement. In my opinion, traditional retirement planning does not currently have a satisfactory long-term solution to the health insurance challenge for an early retiree. Rather than plug in an arbitrary number that may be totally invalid to estimate our healthcare costs, we decided on an entirely different approach to break our analysis paralysis. We can't predict the political environment, the rate of ongoing health cost inflation, or our personal health status 25, 15, or even 5 years into the future. We can know exactly what we've spent in the past year and have a pretty good idea of what we will spend in the next year. Therefore, we're simply planning to work enough to cover our medical costs. We'll either obtain health insurance through an employer or earn enough money to purchase coverage year to year. We plan to continue this until the health insurance market stabilizes and/or we accumulate enough wealth and are near enough to Medicare eligibility to have confidence in a better plan. While this is not a perfect plan by any means, we don't live in a perfect world. We have a far from perfect healthcare system that requires alternative solutions. Our solution was to be extremely flexible while providing the lifestyle we desire as soon as possible. Inside our planning for 2017 and 2018, we originally planned to begin transitioning to our early retirement with me leaving my job in June of 2017. However, my wife had some expensive medical tests and then required minor surgery early in the year, and so we met our deductible quickly. Because our family currently has insurance through my employer, we decided it made sense to have me continue working until December when our insurance year ended. This allowed us to avoid the risk of having to pay a second deductible if switching to a new plan in mid-year. In 2018, we'll switch to my wife's employer-provided coverage. On the downside, she has to continue to work 30 hours per week to obtain coverage, and our costs will increase significantly. On the upside, she has a part-time work-from-home location-independent job with flexible hours that's compatible with our lifestyle. Her employment will allow our family to obtain affordable health insurance while also delaying needing to withdraw any substantial money from our investments for at least the next year. To be continued. You just listened to part 1 of the post titled A Flexible Plan for Health Insurance in Early Retirement by Chris Mamula of caniretireyet.com. I think Chris hit the nail on the head with the main challenges in trying to plan for healthcare costs. There are a ton of factors to consider, and it's incredibly challenging to right-size our assumptions when attempting to estimate costs. Chris was actually attending the same Camp FI event I was at last month in Colorado, where this exact issue was discussed, though he wrote this article well before that event. These Camp FI attendees came up with a fairly complex formula to estimate costs that considers premiums, deductibles, out-of-pocket max, healthcare inflation, subsidies, and more. It's not perfect for many of the reasons described in this article, but it's the most comprehensive tool I've seen for planning around healthcare costs, and it will be available soon on fihealthcare.com. The way I see it, healthcare costs are a risk, whether you retire early or not, whether you have health insurance or not, and especially if you live in the US. I think you need to evaluate this risk as you would evaluate any other risk and recognize that you will have to make decisions without fully knowing the future. I found myself at this crossroads when I was deciding to quit my corporate job and looking at my health insurance options. I ended up buying an ACA plan for much cheaper than I expected. Without any subsidies, I'm now paying $340 per month for a high deductible plan. While I'm sure that cost is going to continue to increase, I decided the cost was worth it for me for the opportunity to pursue self-employment. Well, that should do it for today. Have a happy rest of your day, and I'll see you on the Thursday show tomorrow, where we'll finish up this post and where your optimal life awaits.